And joining us from New York, we have Nouriel Roubini, the current Dr. Doom. He's the chairman of Roubini Global Economics and professor at New York University. He's also the author of a new book called Crisis Economics. Now, of course, we call him Dr. Doom, but he actually prefers to be called Dr. Realism these days. And it's good to have you with us, Nouriel.
It's a pleasure being with you.
All right, so let's talk about realism and a reality check, shall we? Because we had those swap spreads, LIBOR spreads, not much movement there. In fact, they widened at some point during the session. So it looks like the market's still not fully convinced that this $1 trillion package is a solution. In fact, it just really paints over the cracks. What do you think is going to happen from here?
You're right. The markets are not convinced because while there is, unquote, $1 trillion of money on the table, that money is going to be dispersed only if these countries do massive amount of fiscal consolidation and structural reform. And if you think of it, the challenges of reducing a budget deficit from 13% to 3% in Greece look to me like mission impossible. They're not going to be able to raise taxes and cut spending that much. You have riots in the streets, you have people dying in the streets, you have strikes. That's going to get only worse. Secondly, as you raise tax and cut spending in the short run, output is going to fall even more. The IMF expects another 2-3 years of recession in Greece. How much austerity and recession can a country take? Three, all of these countries, not just Greece, but also Spain, Portugal, Italy, have not only a public debt problem, but also a loss of competitiveness. Wages were growing more than productivity. The euro was strengthening until recently, and therefore they have to restore competitiveness, reduce their current account deficits. How are they going to do that? So squaring all these things together, fiscal adjustment, competitiveness, growth, in my view, is going to be extremely hard. That's why the markets are skeptical.
Wow, sounds like there's a lot of doubt there, Nouriel. So what is this, just a temporary solution? I mean, are we going to see the credit market seize up here?
In my view, after the initial euphoria, the market is going to realize that these countries are in severe trouble. I still expect that eventually Greece will have to restructure its public debt in a coercive way. Even the IMF estimate that that would stabilize at 140% of GDP. That looks like too much. Eventually, you have to reduce that stock of debt. And there is even a chance that one of these members of the Eurozone, like Greece, might eventually decide to exit the Eurozone to get a real depreciation that is necessary to restore competitiveness. So I would not even rule out the next few years one or more of these laggards of the Eurozone might be forced to exit the monetary union.
So if we have an exit of the monetary union by one of the members, what does this mean for the common currency? Because recently Jim Rogers says he doesn't expect the euro to be around in the next 10 to 15 years. What do you think, Nouriel?
Well, there might be a euro, but there might be a euro formed by a smaller number of countries that have strong fiscal and economic fundamentals. And of course, the euro was supposed to be a major reserve currency, but for a currency to be a reserve currency, it has to have a limited liquidity and credit risk. And once the currency has credit risk, meaning once the holding of the debt of the government of the member state might be subject to default, who would want to hold that currency as a reserve currency? So the role of the euro as a reserve currency might shrink over time if there is a risk of default by a number of the member states.
So, Nouriel, you going against the grain. When people talk about recovery in the U.S. economy, they're talking about recovery in the Eurozone. You actually said and stepped up saying that the global financial crisis is only going to get worse from here.
Well, it's going to get in a next stage. The first stage was excessive debt accumulation and leverage by the private sector. But in this new stage, we have moved many of the private liabilities to the balance sheet of governments. There is this massive releveraging of governments, budget deficit of 10% of GDP, not just in Greece, but even in the United States is going to be more than 10% this year, and doubling of public debt as a share of GDP from an average of 50 to 100% through most of these advanced economies. So this burden of public debt implies either a fiscal crisis and default, or if you can monetize this fiscal deficit like US, UK, and Japan can do, eventually monetization of fiscal deficit leads you in the medium term to inflation. So those are the risks that we're facing. That's why I'm worried about the next stage of this global financial turmoil.
Yeah, what is the next stage, Nouriel? I mean, you predicted that recession in the housing bust back in 2006. In fact, you said that we might see something serious happening in the U.S. in the next 2 to 3 years because Washington is still not doing anything appropriate or anything about the situation.
Yeah, my concerns about financial risk are related to large deficits and budget deficits and public debt in the U.S., in the Eurozone, in Japan. And what I see in the United States and other advanced economies is political gridlock. The two parties in the U.S., Democrats and Republicans, do not want to agree on anything. In the UK now we're going to have a hung parliament. In Germany, Merkel just lost its majority in his own parliament. Throughout Europe, there is divisions of politicians, very difficult, tough choices to be made. In Japan, you have a weak and ineffective government. So what needs to be done is known. We need to reduce budget deficit, raise taxes, cut spending, do structural reforms. The open question in the US, in the Eurozone, UK, in Japan is going to be, is there a political will when you have divided government, coalition governments, weak governments, to do the right thing? I'm somehow bearish that that political will is going to be there, and therefore policy mistake may be done.
Okay, with policy mistakes, I mean, what exactly could that precipitate? Are we looking at yet another financial crisis? I mean, you already predicted a prolonged recession in the U.S. I mean, what's next to come?
Well, in the case of a Eurozone, in spite of this bailout package, the trouble could get worse. The recession in a number of countries become worse, deflation become worse, eventually default by one or many other members of the Eurozone, eventually one or others exit the monetary union. We saw already last week how the problems of Greece can become first regional contagion and then they led the seizure of equity markets globally, even in the United States or in Asia. So that's one kind of a risk. And eventually the bond market vigilantes that have already woken up in Greece, in Portugal, in Spain, in Ireland, in Iceland, even in UK, may even wake up in Japan and the United States and say budget deficit of the order of 10% of GDP, doubling of public debt is not sustainable, and there could be a financial crisis coming back, even in a major country like the United States. Not this year, but probably the next 2 to 3 years, if we don't do something on the fiscal side, we're going to get into trouble, is significant.
Okay, what about risk over in Asia, Nouriel? I mean, we got to CPI, consumer prices in China rising at the fastest pace in 18 months. The economy continues to be swashed with cash. I mean, even new loans surprised the most optimistic economists for that month. And then you have property prices continuing to surge. Some people, are saying it's overheating right now. You can't expect China to keep driving the global recovery.
There are risks even in China. As you pointed out, there is overheating of the economy. There is both goods inflation rising, and now there is asset inflation, especially in commercial and residential real estate. And it's no surprise for an economy that right now is growing about 11% of GDP growth, having interest rates, interbank rates of 2% with inflation of 3% means that real rates are negative, credit growth is excessive, and therefore we're feeding domestic inflation and we're feeding also asset bubble. The result is that there is a risk in China. China should be tightening monetary policy, increase interest rates, and let its currency appreciate over time. But they are too slow. They're not doing it fast enough.
Okay, so then do you agree with Mark Faber, who says that China's economy is going to crash in 9 to 12 months? And then you have the hedge fund manager, Jim Chano, saying that China is on a treadmill to hell. Are you as pessimistic as these two?
I'm not as pessimistic, but I think that the risk of a significant slowdown of growth in China are there. Paradoxically, in the short run, China is overheating, but most of the growth in the last 2 years have come from more fixed investment, more capital stock, infrastructure, commercial residential real estate, and also overcapacity in the manufacturing sector is increased through even more investment. So in the short run, overheating and inflationary pressure, but the response by increasing the stock of capital might lead to a glut of capacity from real estate to manufacturing that actually is going to lead to a slowdown of economic growth over the next 2 to 3 years.
Okay, well, even though there's a slowdown in economic growth, Nouriel, let's take a listen to Mark Faber, who says there's really no other place to be.
Quite frankly, if you put the gun on my head and say you have to invest all your money and you can choose just one region, I would choose Asia. Because in Asia I can buy lots of stocks They are of good companies. They are partly becoming world leaders, and they have a dividend yield of, say, 4 to 7%. So I think at least I'm paid to wait, given that interest rates are at 0%.
Okay, so there might be doom and gloom across the rest of the world, Nouriel, but would you say that Asia, if you had to pick a region to weather this the best, it would be it?
I'm relatively bullish about Asia. Of course, it's going to be one of the regions with high economic growth. But the caveat about stock markets is that while growth is going to be high in Asia, the markets have already priced it in. In a number of countries, price-earning ratio is already 25 to 30, including places like China, India, and others. And right now, while he's saying let's be bullish about Asia stock market, today we've had a bear market in China with a fall in the stock price from the peak reaching about 20%. So valuation in some sense are high, even if economic growth is going to be strong. That's an important cautious.
Okay, that's something to be cautious about. Nouriel, before I let you go, I want to talk about your new book because it's called Crisis Economics, basically solutions that you're putting out there to prevent the next financial crisis. And some of them include the breakup of large institutions such as GS, Goldman Sachs, I guess implementing the Glass-Steagall's breakup, and also banning CDOs and compensating traders with slices of their own products. So you're taking your own medication. And tell me more about these solutions.
Well, first of all, dealing with too-big-to-fail institutions by imposing higher capital charges or a resolution regime to close them down when they're insolvent is not a good solution. If they're too big to fail, in my view, they're too big and they should be broken up. And not only they are too big to fail, but increasingly they're becoming too big to be bailed out, like it's happening right now in Europe, where the collapse of a financial system would not be resolved through a bailout of the government because the government themselves are semi-bankrupt. So too big to fail, too big to be safe, too big to be bailed out, and also too big and too complex to manage. There is no way they can be managing this financial supermarket in a way that is efficient.
I want to thank you so much for your time today. Nice talking to you. Nouriel Roubini, New York University professor and also chairman of Roubini Global Economics.